Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Hey, when you hear the word risk, what do you think of? You know, retirement can be risky business. Wow, look at that timing. But it doesn't have to be as scary as you might think. You could have fun with it, like Tom Cruise did in the famous movie. You have to identify certain types of risks when it comes to your retirement. That's what we're going to talk about today, so stick around. Welcome to the show, everyone. Show's called Your Money, Your Wealth. My name's Joe Anderson, certified financial planner, and I'm with the big man, of course, Big Al Clopine. He will join us momentarily because he's a huge risk taker. You know, do you skydive? Do you jump out of planes? Well, that could be fun for some people, but you don't necessarily want to do that with your retirement. But you have to identify there's certain types of risks, such as sequence of return risks. How about interest rate risks, geopolitical risks, tax risk, like term risk? I mean, the list goes on and on and on. That's today's financial focus. Here's a risk that you are probably not identifying in your overall retirement. Here's a study, 60% or roughly 60% of people are investing way too conservatively in retirement. So what does that mean? You might be in CDs, money markets, just savings account. I'm telling you what, you will go broke safely. You are losing money safely here because you have to combat something that's called inflation and taxes because your money needs to continue to grow to keep in pace with inflation. So to help break that down, let's bring in the big man right now, Big Al. Interesting study, 60%, roughly 60% are investing way too conservatively. Because I think once you get retired, right, Al, you're constantly looking at your money and you have that fear. I don't want to lose anything, right? I cannot afford to lose anything because I have to draw from it. But if I keep my money too conservatively, people don't really understand that they are actually losing money. It's a guaranteed loss.
Well, we know, Joe, from studies that people are twice as nervous about losing money than the elation they feel of gains. And when you get to retirement years, it's a whole different story because now you've got your nest egg and you feel like you can't afford to lose it. And we understand that. But here's the other thing is longevity. We're living a lot longer, so your money's got to last longer. If you retire, let's say at age 65, and you're married, there's a 50% chance that at least one of you is going to live to age 90 or longer. So anyway, to break this show down, we're going to go over certain risks that you need to be prepared for and know how to deal with. The first one, of course, is running out of money. No one wants to run out of money. So we're going to talk about how you know how much you can spend in retirement and some ways to make sure that you absolutely don't run out of money. A second thing is investing, making sure you have the right investments, the right investment risk. If you're too aggressive, you risk losing your portfolio. If you're too conservative, you're going to lose your money safely. So there's got to be some kind of balance there. Sequence of returns is another one. You may not have even heard about this one. This is where if you retire and you have some down years in the portfolio, it makes it much harder to successfully retire. We'll go over ways to combat that. And then finally, taxes. And taxes are maybe going down under the current administration. We don't know. But it does seem that taxes will likely go up at some point in the future because of the national debt. And Joe, it's inflation and taxes. We come back to that over and over again. These are things that a lot of people don't really think about too carefully in their retirement planning.
You know what? It's challenging to retire today. Right?
It is.
You got all-time low interest rates. We got a crazy stock market. Right? We got healthcare costs are on the rise. And then a lot of us have to create our own strategy to create the retirement income. It's not like, all right, let's just transfer all of our assets to our company. Well, they'll provide us with an income stream for the rest of our life. Those days are long gone. Now it's up to us to create the retirement income. For us to do that properly, we have to identify certain types of risks and what risks are we taking and which risks we're going to face regardless and hedging those as much as we possibly can.
Yeah, and right off the bat, Joe, we know that this is what we're seeing. The percentage of people having trouble maintaining their lifestyle in retirement, it's going up. 1983, it was about 30%. Now it's over 50%, approaching 60%. So that we know that it's harder and harder for people to cover their lifestyles with the savings they have, with the pensions that they have. And Joe, when you think about pensions, I mean, there's a lot less pensions, certainly in the private sector.
Right, I mean, that graph shows it right there. I mean, back in the 80s, only 30% were having a little bit of difficulty trying to, maintain their lifestyle. Right now, it's at almost 60%. Where do you think that number is going? It's going to continue to climb because pension plans are going down, right? And then you've got the uncertainty of Social Security. So it's figuring out what is the appropriate strategy to figure out how do you create the income from your portfolio. And unfortunately, there's not a lot of schooling, right?
Really.
To say, all right, this is how you do it. So let's just talk high level. What type of or what percentage should you be pulling from your overall portfolio? This is called a sustainable distribution rate. This kind of at least helps you identify how much that you should be pulling from your portfolio. Al?
Yeah, Joe, we've got 3 scenarios, retiring at 55, 65, and 75, starting with $500,000 in each case. Now, a 55-year-old probably should not distribute more than about 3.3%, meaning that 3.3% of $500,000 is about all they can withdraw, which is $16,500. A 75-year-old, well, they've got less longevity because they're older, so they can probably pull out somewhere around 5.3%, about 26%. But look what happens to the 55-year-old. Let's say they have a pension of about $30,000. They can only spend about $46,500 in this example. You move over to age 65, not only is your pension a little higher, but you got Social Security and you can withdraw more from your portfolio. It's about $80,000. You get to 75, now you're approaching $100,000. And Joe, we talk about this all the time in terms of how much you can actually spend. You can spend a lot more if you retire later.
Right, and I think the whole goal of retiring at 55, that's a great, admirable goal, but it's almost impossible in today's environment. You have to have a lot more money saved. And we're living a heck of a lot longer, Al. So, I mean, well, why can't we look at 75 should be the new retirement game plan, because you're going to probably still have a 20-year retirement. Plus, the likelihood of you having a lot healthier income is significantly higher. Then you look at, all right, well, what does this mean? I'm pulling 3.5% out, 5% out, 5.5%. Well, what does that equate to in overall returns of the market? Because you don't necessarily want to pull, all right, if the market averages 5, 7, 8%, you're not pulling 5, 7, or 8% out of the portfolio. You've got to pull something less out just to combat inflation over the long period.
Yeah, that's right. And Joe, when you look at average annual rates of return on certain asset classes, S&P 500, the largest 500 companies in the U.S., 10% is the average return over the last almost 100 years, and it's about 7.3% in the last 10 years. But you look at T-bills, government T-bills, and it's much lower. It's only about a little over 3% long term. The last 10 years, it's been about 1.1%.
Are you data mining these numbers here to scare people?
Yes.
I mean, the past 10, I mean, look at those numbers, right? Over the past 100 years, it's 10%, but over the last 10 years, it's 7%, so be careful because we're in the new normal. Well, guess what? On that 10-year period, you started in 2006. We all know what happened in 2008. The market blew up. That's a too short a time period, Clopine.
Well, that's why I gave 100 years before that. But I will say, here's the point. The point is, if you're all in cash, and that's what we talked about, Joe, at the very start of the show, you're not going to have enough rate of return to make this work. So, I mean, let's just take a look. Investing 101, what do we need to do here? Yeah, let's start with calculating your family index, which means figure out what rate of return you actually need to make this portfolio work, right? If you need a 6% return, then don't invest all in the market because it's going to be too volatile, right? Then design that safest portfolio to meet your needs to get that rate of return. We call that goals-based investing. Make sure you globally diversify with low-cost funds instead of trying to pick stocks. Stay in the market. Don't try to time the market. And then monitor your portfolio. Rebalance as appropriate. Tax manage if certain accounts go down and they're outside of your retirement accounts. You sell those. You create a loss. You buy something similar. So now you're saving taxes while you have the right investments.
Right. I think one of the key components there is that you want to take the least amount of risk possible to accomplish your goals. And I think most of us do not understand what that number is. So it takes a little bit of planning. What rate of return do you need to generate to make sure that you can do all the things that you want to do for the next 30 years? Construct that portfolio to make sure that you're mitigating your risk as much as you can, right? And then that you can still accomplish everything. And then make sure you're monitoring it. Take advantage of that and make sure, all right, am I still on track? Am I spending a little bit more, a little bit less? And then take control of your money. Hey, we got to take a short break. When we get back, we're going to talk about the absolute biggest risk that could blow up your retirement, so you don't want to miss this. Good morning, everyone. You're watching Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. I'm Joe Anderson, and I'm with Big Al, of course. We're talking about risks in your retirement. There's good risks, there's bad risks, and you have to identify all the risks that could affect your overall retirement. Before we get into the biggest risk that will blow up your retirement, let's get to the true false and see how you did.
Savings accounts are good investments because they are risk-free. Well, interestingly enough, Joseph, I would say some of both. A little bit true, a little bit false. They are good investments. You should have some. However, they're not risk-free. You know why? Because they generally don't even keep up with inflation. And that's a huge risk, inflation. In fact, when you have all your money in savings accounts, it's almost guaranteed you're going to lose money over the long term because it's eroding your purchasing power. You just are not going to have the money to buy the things that you need to and want to later on.
That was kind of a trick question there, huh?
Yeah, it's a true and false.
Because people were saying, well, is it FDIC insured? I'm not going to lose any money. But
I know,
wait
right?
a minute, we're talking inflation, folks.
Yeah, right. So, Joseph, this is the time of the show where there's a question that is asked of you to see how you do. We call it Countdown to Retirement.
What is the best way to convert from a traditional IRA to a Roth without losing money?
Let's see here. All right, so the question is, what is the best way to convert to a traditional IRA to a Roth IRA without losing money? I'm not quite sure what he means by that, but here's the deal. Anyone can convert to a Roth IRA. So if you have money in an IRA, 401k, 403b, or any defined contribution plan that you've saved pre-tax that is growing tax deferred, when you pull those dollars out, you're going to be taxed at ordinary income rates. A strategy that we talk about quite a bit is to take some of that money and convert that into a Roth IRA. Why would you want to do that? Because then all future growth of those dollars are going to grow 100% tax-free. You'll never pay tax on those dollars again. I convert $10,000 to a Roth. I'll pay a couple of bucks in tax today, but that $10,000, whatever growth that is, it's all mine tax-free. How do you not lose money? I guess it's depending on the investment that you choose, right? You could use cash, you could use stocks, you can bonds, anything that you want into a Roth IRA. But every investment is subject to risk, and that's the title of the show.
Very good. That was about 64 seconds, but we'll accept that. I think that's exactly right, Joe. I mean,
how many questions does that guy have, by the way?
He's on every week. I do know that.
Every week. Man, we just got to get him live in the studio.
I think he was on all last year too. Come to think of it.
We got to get a name for him.
At any rate, yeah, Roth IRAs. We're big believers in Roth IRAs, by the way, because once you get money into a Roth IRA, it's 100% tax-free. Now, when you do convert, you do lose some money in a sense because you pay some taxes. But here's the key. The key is, are you going to have more money in the long term because the less taxes you'll pay? That's really the key. You may lose a little bit of money up front for taxes, but you gain money up front.
Yeah, but I don't think you lose money. I mean, there's no way around the tax in those accounts. That's the biggest confusion.
That's the confusion, right? Because when you think of the taxation, Joe, it's you don't really have all of those dollars to spend.
If you got $1 million in an IRA, you don't have the full million. You have something less than that because the dollars that come out are going to be taxed. So you have to take a look at tax rates today, tax rates in the future, and then you have a diversified strategy to pull your money out to mitigate that taxes long term. So, Roth conversions make a lot of sense for a lot of people, but we would suggest you do a little bit more detailed planning for that.
Yeah, Joe, let's get into probably one of the biggest risks out there that a lot of people don't really understand. It's called sequence of returns risk.
Huge risk.
And that just simply means, what if you retire and the market declines or it crashes? You're much less likely to be able to fund your retirement the way you want to. And here's an example. You got $1 million and you're withdrawing $50,000 a year, inflation at 3%. On the left-hand side is an early market decline, minus 10%, minus 5% flat, and then for the next 27 years, it's 7.5%. How about on the other side? It's the same average return of 6.25%, but here the losses are at the end. And it's a completely different scenario, what happens with these two scenarios.
Right, because here you have to look at the math of financial planning, right? Let me give you a quick example, is that you can't use an average rate of return. It's the sequence rate of return. Because if you have a negative 30% one year and a positive 30% the following year, your average rate of return is zero. We'll come back to that. So what I want to, if you're pulling money from this now, all right, think of it like this. So if it's an average rate of return of 0, but if you have $100,000 and you lose 30%, and then you gain 30% on that $100,000, your average rate of return is not 0, it's negative. So when you look at declining markets and you're pulling dollars out, and especially with those declining markets in the beginning of your retirement income strategy, that's where we see this huge differential. So in our example, one client had positive returns when they first started to retire. The other example is they had negative returns. This is negative returns in the beginning. They blow up. They are out of money. But with the same average rate of return, but it's when that return hits their account, this client is living the dream. Right? So do you have a strategy to combat that? Most people talk in averages. Average means nothing in the world of financial planning, especially when you're trying to create retirement income.
And we all want to live the dream.
We do. Right. I want to live the Alan Clopine dream.
We want to live the dream.
Have you ever seen the Griswolds?
Our vacations, everyone are just like that.
It's unbelievable.
So let's talk, Joe, about how to mitigate the sequence of returns risk. So first of all is invest in the safest portfolio possible. We talked about this last segment. Do a little analysis to figure out what rate of return you need. If it's 5%, then devise a portfolio to earn 5%. Don't be too risky, because the risky you are, the more you have in the stock market, the more volatile it's going to be and the more subject you are to this risk. Here's another one that a lot of people don't think about, but make sure you've got 7 to 10 years of your portfolio in very safe assets, because if the market declines, you want to be able to pull from those safe assets. Let the stocks, they're going to go down, but they're going to come back. You don't want to be taking money out of the stocks, Joe, when the stock market's down.
Here's the deal, is that when we say the safest investment possible, that doesn't mean cash again. You still have to take on a sort of risk to make sure that your money lasts. Another big risk is tax risk, right? So now you're taking a look, all right, well, here I got sequence of return risk, I got to build this portfolio, but then you also have to take a look at how your income is going to be taxed. Because if you can reduce the taxation of that income, you can take significantly less risk. You can take less risk in the portfolio. Because basically there's 3 different pools of money that you can invest in. You got a tax-deferred pool, you got a tax-free pool, and you got a taxable pool. And a lot of times most people's assets are all sitting right here, Al, because that's what is, or I mean in the tax-deferred pool, because it's all ordinary income tax coming out to them. So they're paying the highest rate. But if you could be diversified in your strategy and have a little bit of money in tax-free, have a little bit of money in tax-deferred and taxable, you can significantly reduce the amount of taxes that you pay, right, when you start taking those distributions. It's incredible. I mean, you could be in a very low tax bracket with a lot of cash flow. Because right here, this is where most of your assets are. And you're going to get taxed the highest of rates. But if you could get money in this pool, we like that one. That's tax-free. 0 taxes for the rest of your life, your spouse's life, and then the kid's life. If you have money here, that's pretty cool too, right? But unfortunately, what we were told is we jammed every last dollar that we own in this pool here, and most people, when they approach retirement, you hear, I'm going to be in a lower tax bracket, and we find that that's just not the case.
Yeah, that's not the case when you've saved. I mean, if you haven't saved much money, you will be in a lower tax bracket. But if you have saved, if you've done the right thing, maybe you got a pension plan, Social Security, then you very likely will be in the same bracket, if not higher. So let's go through an example of how this might look. If you did the right thing, you got money into a Roth IRA, and here's a couple that they're living in what we would call the 28% tax bracket, but only paying 15% taxes. And that's here. Look at this. IRA distributions, Social Security, so $100,000, all right? And let's just stay on the left side. This is their actual income, $100,000. They're taking $30,000 out of their Roth IRA, and then they're pulling money out of their taxable accounts, another $30,000. So they're living on $160,000. But then you go to the tax return. $95,000 is the taxable IRA and Social Security, because not all of Social Security income is taxable. IRAs are tax-free. Taxable accounts may or may not have capital gains. In this example, no capital gains, because you've already paid the taxes on it. Deductions of about $20,000, and you end up with a $75,000 taxable income. So for a married couple, that's in the 15% bracket. So you're spending $160,000, but your tax return is showing that you're in the lowest of brackets, that 15% bracket. This is really, Joe, what everyone's goal should be when it comes to retirement planning, because then their money is going to stretch that much more.
Right, and then this takes what? Planning. You have to look at what your goals are, right? And then you have to take a look at what your fixed income sources are. What are you trying to accomplish? And then build with all these different strategies that we talked about. What type of portfolio should you have? Take the least amount of risk. What percentage are you going to pull from the portfolio? And then make sure when you construct it, take the least amount of risk possible. But also you want to make sure that you have stocks and bonds. And then finally, you look at the taxation of the income, and if you can control that, right? You're controlling the things that you can control, which is key, and that's going to give you a lot more confidence. Confidence breeds success, right? We want you to be confident in your overall retirement.
And
hopefully,
then you can live the dream.
Then you can live the Alan Clopine dream. All right, we got to take a break. When we get back, we're going to flip the show to you. We're going to answer some email questions, and we're going to jam a whole bunch more in, so don't go anywhere. Woo! Hey, welcome back to the show. Show's called Your Money or Wealth. My name's Joe Anderson, certified financial planner alongside the big man, Big Al Clopine. Thank you. We're talking retirement risk today. Before we kind of wrap up the show, let's go to the true-false question.
Small company funds always receive higher returns than large cap funds. Well, that's false, of course. Every time you see always is never true. Now, here's the truth, though. Small company funds generally outperform large company funds over the long term. But year by year, that's certainly not always true.
Smaller companies have higher expected return than large companies.
That's right, because they're riskier, right?
Yes, over the long term, yes, you will make more money in small companies versus large, but not always every single year. So that was Clopine wrote that question, I guarantee.
No, I didn't. That was that was our producer.
Definitely, that was your question because you love always, never.
Yeah. Well, then you know it's false if it's always.
Hey, we're looking at managing risk this morning. Running out of money, don't do it. Right? It's very difficult not to because we haven't have enough saved. So you got to figure out how much money that you need to have saved. Take a look at the investment risk that you're taking in your portfolio. There's all sorts of different types of risk. There's inflation risk, term risk, and then market and business risk. Then you have to look at the sequence of returns. Do you have a strategy to pull out your overall retirement income and making sure that when the markets are volatile, it is not going to blow you up? And then, of course, Big Al got into the tax aspects of it. So all of those different things is what you really want to make sure that you have nailed down in any proper retirement income strategy. And there's so much more, but we only have so much time. Let's flip the show back to you. I think we got time for maybe one or two email questions, and then we'll get out of here today.
All right, this is from Peggy in Encinitas. We liquidated all of our stock investments and now only have cash. My husband and I are in our 60s. We're worried about losing our retirement funds. Should we get back into the market or stay in cash? We'll probably need to save about $150,000 more to retire comfortably in about 5 years. So, Joe, we got Peggy and her husband got out of the market. What do you think of that?
Peggy, get back into the market. Have the right portfolio based on what your goals are because you, just like the show said, your cash is not going to get you there. Especially, it sounds to me that you don't even have enough money to retire. You still need to build up that nest egg. If you had millions, then sure, stay in cash, but it sounds like you still have to build up the portfolio. So this is a big mistake, Al. I think a lot of times, hey, we're close to retirement. Let's just go into cash and then we'll cruise right in. But what are they forgetting? Well, your time frame is not your retirement date. Your time frame is end of life. So you want to make sure that you have enough risk in the portfolio to make sure that you can maintain that lifestyle for the next 30 years.
That's absolutely right, Joe. I couldn't have said it better myself.
Wow. You want to throw any other nuggets in there, buddy?
No, because we got 10 seconds. Actually, I will say one quick thing, Joe, and that is when you got your retirement portfolio, that doesn't mean you're all in or you're all out. You should figure out the right balance for you. And maybe it's 50% stocks and 50% safety. Maybe it's 60-40, 20-30, whatever.
Right. It's really dependent on your goals. So here, but this is what we do. Get a plan in place. Get a plan in place. It's not going to, plan itself. You got to do it. Hey, for Big Al Clopine, I'm Joe Anderson. Good morning. You just watched another episode of Your Money or Wealth. Boom.